What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be taking a look at MongoDB stock. This one is very interesting because this stock is down 17% today. However, they raised their guidance yesterday and their earnings were great. The EPS beat was they reported $1.16 when 69 cents was expected. But the reason that the stock is falling now is because the CFO and the COO are leaving. And so that is what is upsetting investors a little bit. And so that is the story we have going with MongoDB. Now, as you can see, the last 5 years for this stock has been very volatile. There's been some really huge highs, 569, and there's been some huge lows, 147. And right now we're right in the middle of that. But when I first start looking at this company, the first thing I notice is that their revenue numbers are pretty strong. Their growth is pretty strong for revenue. They're averaging 44% growth per year for revenue. But the net income is a disaster and they're losing lots of money, hundreds of millions of dollars. So that's why I think this valuation is way overvalued because why would you pay $21 billion for a company that is losing money every year? And you could argue that, you know, one day they'll be profitable and it'll still pay off. But for me, there's just too many years of them losing money and it's not something I'd be interested in buying. But from a lot of other perspectives, it's not too bad. The cash to debt ratio is not bad. 2 billion in cash, 1.1 in debt. Shares outstanding is going up, which is bad. This is a bad thing, not something that is surprising me because it's a money losing company. And then if we look at what analysts had them doing, although EPS was actually down this year, it's expected to go back up to 3.2 next year. And revenue growth is about 17%, which is pretty strong. But even though they are the bottom line is negative. But let's say we were to take the stock price and divide it by next year's earnings, you're paying 91 times earnings for a stock that is losing money, right? That doesn't make any sense. And a stock that its EPS went down, so it's going to be flat. It's going to be flat over a 2-year period, and you're paying 91 times earnings. That doesn't make any sense to me. So that's what we got going on with the EPS. Now, if we look at the price to sales is not bad, right? From a sales perspective, it's not too bad. I mean, 13 times is expensive realistically, but for where it normally trades, I mean, these numbers, 25, 35 times sales is just insane. That is ridiculous for almost any stock. But 13 times earnings, I mean, it's not cheap, but for this company, it's cheaper than where it normally trades. So not horrible. But this is not a stock I'd be interested in buying. It has interesting financials. It's interesting the way the stock is performing now, even when they raise their guidance and their huge EPS beat, but not a stock I'm interested in buying. Let me know if you guys think differently down below, and I will see you in the next video.